So this video is on going from cash-based accounting to accrual-based. Why would this happen? A lot of small businesses operate purely on a cash basis. They don't do accounts payable, accounts receivable. What they do is when cash is received, they record that as revenue, and when cash goes out to pay bills, that is regarded as their expenditures, and they do their their cash inflows minus their cash outflows, and that gives them their cash basis income. So why would we need to convert it to accrual based? Well, maybe this company needs some financing. They want to go to the bank with a proper financial statement that is, according to GAAP, accrual based, and so we have to make that conversion. I don't get into any real complicated problems on the exam on these, maybe a simple one or a complicated bonus, but you need to be aware of what it's all about and basically how it works. Okay, so in this problem, I think this is brief exercise 312. You've got the Kelly Company, cash receipts of $142. Okay, so their cash receipts $142. Their payments during the year of 2017 were $97,000. So their cash basis income is $45. So if we want to get that to an accrual base, we have to consider the receivables and payables and prepaid expenses, or the receivables and the prepaid expenses for the beginning and the end of the year. Okay, so at January 1, let's start with this one here. At January 1, 2017, accounts receivable were $13,000. Okay. So let's see what must have happened then. In December, they would have made an entry, accounts receivable, $13,000, and service revenue. So this $13,000 is really 2016 revenue, but the cash is going to come in 2017. So in order to adjust this, we have to reduce this by the $13,000, okay? Because that represents cash that will come in 2017, but the sales were really last year. Okay, and then we have to look at the December 31st accounts receivable. So this would be the journal entry that the company would have made at the end of 2017. And so this would be a case where you've booked accounts receivable and sales revenue for 2017, but the cash is not going to come in until next year. So if we look at that, we would have gone at the end 18.6 sales revenue, and so the cash won't come in until next year. So for this to get to an accrual basis, we have to add that 18,600. So to get from cash to accrual revenues, we're going to go plus the 142 plus the 18.6 minus the 13, and so our accrual-based revenue for the 2017 would be the 147.6. Okay, now for the payments part of it, payments for operating expenses were paid out of $97,000, but when we come up here and look, at January 1, prepaid expenses were $17,500. So what's that all about? If we look at our prepaid expenses, that would have been prepaid expense and cash that happened in 2016. So the cash was paid out in 2016 for an expense that's really going to happen in 2017. So in that instance, we're going to have to add that. We're going to have to add that to our, as an adjustment to our expenses for the year. And then we come down to, at December 31st, prepaid expenses were $23,200. Okay, so the journal entry for that would have been prepaid expense and cash. So cash would have been paid out this year for expenses that don't happen until next year. So for that, we are going to deduct it to get to the accrual basis. So we end up with accrual-based net income of $50,600 here as opposed to our cash basis of 45,000. So that's your basic principles for converting your cash base to accrual, usually for the purposes of getting financing. Okay.